Today on the Insight Bridge, we do a retrospective journey through Jeremy Grantham's life from the founding of GMO to his foundation and work on climate change. Jeremy Grantham has had a long and storied investment career. He is best known for co-founding the asset management firm GMO in 1977 and serving as the firm's long-term investment strategist. As its strategist and member of its asset allocation team, he developed a unique knack for calling out market excesses, including famous calls around the Japanese bubble, the tech bubble, and the great financial crisis. Jeremy also cultivated a keen research interest in commodities. This eventually shaped his views on carbon and climate change. Based on those views, in 1997, he founded the Grantham Foundation for the Protection of the Environment. More recently, he doubled down and agreed to give away 98% of his personal wealth to fight climate change. We are excited to have Jeremy today on the... All right, so maybe with a little bit of irony, I bet a lot of our listeners did not know that your very first job was as an economist at Royal Dutch Shell. So what did you learn being an economist and working at an oil company?
Well, I had a great assignment, which was briefing people heading off to North and South America. So all I had to do all day was study the economics and the kind of general social differences of South American countries and the US. So that was a pretty easy job, cushy job, I would say.
I recall reading that you actually thought at that point in time that coal was a better investment than oil.
I got to go to Harvard Business School on the payroll because I did a rather adventurous thing for a newbie. I wrote a paper that argued that the US really should have been a coal-based economy rather than an oil-based economy. It had 16 years of oil reserves back then, it thought, and it had 400 years of coal supply. That seemed an impressive difference to me at the time.
So after Harvard, after Royal Dutch Shell, you go to Battery March. So this would be early 70s when you joined. And I hear you were one of the first to do or introduce indexing to your clients. What was the backstory on all of that?
We started Battery March in 69. And in 71, my senior partner, Dean LeBaron, had a buddy, Lee Bodenhammer, who was teaching a class at Harvard Business School, a summer class. Actually, I think it was an Easter class in the Easter break for pension fund officers and endowment officers, not the Yales and the Princetons, but the next group down. The case was, how would they pick between a representative of the establishment, which Morgan Guaranty Trust in those days, JP Morgan these days, and they owned a very big chunk of the pension business. And the New York banks owned everything in those days. And the second one was the new guy on the block, T. Rowe Price. Hard to imagine. But they were very new and shocking at the time. And the third one was even more shocking, which was a flaky little startup in Boston that was buying stocks no one had heard of. You have to remember this was the Nifty 50 era where Morgan Guaranty Trust was recommending Coca-Cola and IBM. And at Battery March, we were recommending Great Lakes, Dock and Dredge, and Twin Disc Clutch. And so they studied these three and then tried to make a choice. And at the end of the class, as was typical, the professor asked the visitors sitting on the back who had not been allowed to say a word for their final comments. My final comment was, when I looked at the data of the three managers and the S&P 500, I was surprised that no one had suggested giving their money to the gentleman at Standard & Poor's. And it went over like a lead balloon. But as we drove back down into town, I was hammering on to Dean LeBaron that we should offer an index because it was a zero-sum game. And we did. And at the end of a year, Pension and Investments magazine gave us some joke award for being the most talked about product with no business. It was 2 years before we got one of the Bell telephone systems, and we were off and running, and we split the business with Wells Fargo. And Wells Fargo was touting the fact that the market was efficient. Of course, that was nonsense in those days. But if the market had been efficient, then of course, indexing is the way you have to go. Our reason was quite different. Our reason was that it was a zero-sum game, that managers in total created no value, that we cost the marketplace 1 or 2% in friction, commissions, and management fees. And therefore, the group of people, I like to think of them sitting at the bar watching the poker game, they would sum to the market minus a few basis points. And the guys at the poker table would have to pay table stakes of 2% a year to play poker. And we would shuffle the chips around, and some would be big winners and some would be big losers. But one thing would be certain: at the end of the year, the end of the game, if you will, we would be zero sum minus the table stakes of 2% a year. And the guys at the bar watching would sum to zero. So they would be 2 points ahead of us and indexing would win. That is the argument of the zero sum game. It's as true today as it was then. And it means that the very big funds are, in the end, fighting it out around a minus cost of doing business level. And that over time wears them down. So the indexing will beat most of the people most of the time.
That's pretty interesting. So if I remember my financial history, I think Samsonite pension was probably one of the early pensions, maybe a year or two prior. And then then a couple years later, you have Bogle and Vanguard. So you were probably one of the very few doing that. And probably not surprisingly, you didn't get many clients because this was kind of a heresy at the time.
Well, one of my friends on Wall Street, good friends, he said, Jeremy, you don't understand. Americans will never settle for mediocrity. And he was right, because if you fast forward from 71 or 73, when we got our first account, if you fast forward to 2005, it isn't even 2% of the business. It's only in the last 15 years that it's exploded towards 40%. Why would it take, in the face of absolute logic, why would it take 34 years to get to 2%? It's a testimonial to the vigorous defense of the financial business and the obfuscation we could put out around the topic.
That's interesting.
By the way, Samsonite went into Wells Fargo and said, we want an index. It wasn't Wells Fargo who went to them. So although they have the honor of beating us by quite a bit, they don't have the honor of having suggested it. And we quite separately had no idea that Samsonite existed on the planet, in a sense. We came up with it from first principles. And then we shared the business for quite a few years with them.
For years and years and years, there's no interest in indexing, very slow. And then all of a sudden in the last 10, 15 years, it's really exploded. Now, there are different weighting schemes for passive indices. Any thoughts on cap-weighted indices right now, given how expensive the market is? Do you still recommend the classic cap-weighted S&P 500 for investors?
I've always thought that an enterprising money manager, if you will, a good poker player, can impose his trading costs or her trading costs on the other poker players and come out ahead. And we have. And particularly in the early days, it was relatively straightforward. There wasn't the same quantitative competition. There wasn't the same top-level intelligence in the marketplace. So I had the feeling that you showed up for work, you tried hard, and you won. It was pretty encouraging and pretty straightforward. Yes, you could pick the winners, and there was plentiful supply of inefficiency. But to get back to the weighting system, the beauty about indexing is you never miss an Amazon or an Apple. And the bad thing about indexing is you never miss having a lot of overpriced stocks into one of the relatively rare bubbles, such as we have now. So it's kind of good news, bad news. If you can ride out the odd 50% decline, totally unnecessary, of course, on fundamentals, as Schiller pointed out 30 years ago. The market is mildly hysterical from time to time, and it's totally unjustified by the steady stream of dividends and earnings. But it happens. And if you want to ride those 50% drops, good luck. It works out very well in the long run. But it can take you 20 years to get back in the game. If you get caught in 1929, it works out just fine, but you don't get your money back until 1955. If you get hammered in 74, you don't get your money back until 87. And then when you've gotten it back for a month or two, you give it up again. And the same in 2000. By 2010, you're still losing money. So you have to be willing to ride out. And some people feel their lives aren't long enough to take the odd 10, 15, 20-year wipeout. So for those who feel they're brave enough and willing to try, I've always thought that sidestepping some of the pain might be a good idea.
So after Battery March, you go on to co-found GMO in 1977. Talk about those early days. How did that kind of form your investment philosophy? And any good stories you can share?
Well, one good story was that when we decided to get into international, there was no good data. There was no machine-readable data at all on the planet. So we got a publication that was just changing hands it was called Morgan Stanley, and then it moved to Capital International. And we got every month, and we hand-entered all the data to see if we could run on our new computer some of the things we were doing in the US. And we were a hard-nosed value manager, so we wanted to know price to book, yield, price to sales, etc. And we ran them, and we found it worked even better in the international markets than it did in the US. And it had worked very nicely in the US. And we had already had quite a few successful years. The 8 years at Battery March, where Mayo and I ran the portfolio, we had won by 6 points a year. The first 9 years at GMO, we won by 8 points a year without any down years. So we were very, very eager to see if the same value approach would work. And there we are looking at the data, and it works even better. And that was the first machine-readable international database was there. Can you imagine? This little firm in Boston, and we were running on a computer stuff that did not exist anywhere else. And to get there, we had to hand enter the damn stuff. And then when we went to our clients, because we were doing so well, they were very receptive and they signed up. We made 23 presentations for 24 accounts. Well, that's another story, but that's the way to get into a new market. So we had these 24 international accounts, and we sold all the hot shots their first international portfolio, including Harvard, Yale, Princeton, Stanford. The first dedicated international portfolios that they ever had were our portfolios.
Wow. That's back in the days when alternative investing were things like real estate and international stocks.
They had not been heard of in those days. I think actually they had a tradition of a bit of real estate, but we're talking 1981, 80, 81, 82. And then we closed when we had our 24 accounts, or was it 23? We closed the book of business for quite a few years because we figured that was enough money to do. It was about 550 million. It was enough money to get our teeth into.
One of the first in indexes, one of the first using international databases, hand put in yourself. So those are some pretty good firsts. I don't know if we were the first, but you certainly received a lot of accolades as being one of the earlier people to call several bubbles. So you've called the Japanese bubble, the tech bubble, the GFC. Is there a template to help uncover bubbles? And maybe how were those bubbles different? How are they the same?
Well, I think they're perfectly straightforward. They're intellectually easy and psychologically disastrously difficult. They're easy because in most cases, they're so extreme. It's like, how do you notice the Himalayas when you're standing in northern India? I mean, they come out of the plane and they soar up. You can't miss these things. 1928, 29 was just such a massive rally. So the sheer price rise, you can't miss. Secondly, just to make it easier, the great bubbles have always tended to rise faster and faster towards the end. And that's a kind of defining feature also. And then thirdly, they have all been accompanied by massive, public, obvious, crazy behavior, where the headlines migrate from the financial page to the front page, where they migrate to the opening few sentences of the evening news on the radio or the television. And they talk about market new highs, and they talk about what the Bitcoins of the era have done. I know it's not a stock, but it's a speculative instrument, and the GameStops of the world. And back in 2000, most of you will be old enough to remember the pet.coms and the utter craziness of that period. And the same was true of 1929. The same was true of Japan. We had a group from Salomon Brothers, a leading American brokerage house of the era, who came around in 88, 89, when Japan was moving to 60 times earnings, and explaining that their yields, et cetera, and their interest rates, et cetera, they really should have been selling at 100 times, and they were cheap, and you should buy them. And it didn't stop the Japanese market breaking the following year. It has not recovered the high of 31 years ago yet.
So it's one thing to call a bubble. Timing it is another thing. And maybe even foresight is a curse. So talk to me a little bit about the business pressures of being early or calling a bubble, especially in a time of exuberance.
What we found in 98, 99 was that it was far more commercially dangerous to be early getting out of a bull market. than it was to make mistakes in a bear market. That in a bear market, all the clients became mildly catatonic and some severely catatonic. And when the market's going down fast and a lot, they kind of freeze and wait until it's all over, and then they sort through the wreckage and decide what to do. In a bull market, it's quite the opposite. They are jumping around full of energy, playing golf with their fellow pension fund officers who are hitting the ball out of the ballpark. And, what the hell are they doing with these conservatives at GMO who are up 16% when the market's up 22? And Fred, that they have just heard about, is running a company that's up 41. I'll have more of the 41, please, and less of the 16. And so you get fired much more quickly in a bubble phase than you do in any other phase. And furthermore, we noticed in 98, 99 for the first time, you get fired with a certain amount of venom. They treated us as if we were deliberately trying to stop them getting rich. And I'm not kidding you. And these were, of course, some of the best committees or the most talented committees full of movers and shakers in the investment business on these great endowments and the metropolitan museums and so on. And yet, almost invariably, several people on the committees had bought into the new golden era that Alan Greenspan was talking about, permanent hire, this, that, and the other. And they felt the market was justifiably heading towards 35 times earnings when it had never sold over 21 before, and that was 1929. So that was pretty painful. It taught us, in a sense, a powerful lesson about how human behavior works. But it also explained to us why the big firms couldn't play that game. It is simply not a commercial proposition to get out of a bull market, because every now and then they run further and faster than you expected. Japan went on and on and on, way beyond people's expectations. 2000 beat the record. There's a lot of difference between 35 times earnings and 21, the previous record. So sometimes they break out to an astonishing degree. Now, the bad news is that changes nothing. They go back even more and longer, and they go back where they came from. And the higher they go, the harder and longer they fall. But it changes everything when you're there, because the client's patience, which was normally 3 or 4 years, if you're a good manager and you talk to them nicely and you keep them informed, the standard patience is 3 years. And if you've done a great job, it may be 4. But we got fired by 60% of our book of business in 99 in 2.25 years. At the end of 97, we had good numbers going back 5-10 years, and sometimes very good numbers. But in 2.25 years of lagging, we were getting positive returns, but we were way behind the market. We were getting fired at a rate I've never seen before or since.
Foresight sometimes may be a curse, but it's so behavioral when you get into these situations. And it is funny how history repeats itself. You mentioned some of the comments and quotes by Alan Greenspan, but I believe it was Irving Fisher in the late 20s who said, we've reached this permanent plateau. Fast forward to today, and we've been mostly talking about stocks. It feels we're in this environment now, we're in this everything bubble, where it's not only stocks, but it's bonds. So if we're in a bubble, what's an asset allocator or investor to do?
And by the way, this is not a digression, but it's not answering your question. When you're having a bubble, it's really advisable to have the bubble be in one focused area. In 2000, for example, it was US growth stocks. It was not global. And real estate was really cheap, as in cheaper than the cost of building the building you could buy real estate for. Bonds were really cheap, and inflation-protected bonds had just come out, and they yielded 4.2%, 4.3%. I mean, can you believe it? Real return guaranteed against inflation. Even within the market, the value stocks were not too bad and the small stocks were not too bad. And small value was actually cheap enough that when the S&P had gone down 50%, it hadn't gone down at all. It was, I think, +3. I mean, amazing. And the REITs, all of the real estate, they were up 30% as the S&P hit -50. That was a bubble that was paradise for an asset allocator because there were so many alternatives. What you want to avoid is what Japan did in 89. Japan had the biggest bubble in history, I believe, bigger than the South Sea bubble, and that was in land and real estate. And the old story, the land under the Empress Palace was worth more than the whole state of California. We spent 2 days actually asking and digging, and it was. It literally was. First of all, it's a big palace with great palace grounds. And secondly, downtown Tokyo, all around it, was selling for, 4, 5, 6 times downtown Manhattan. And the numbers worked out. Just amazing. simultaneously, they had the biggest equity bubble of any important market. There are some flaky, tiny markets that don't count. But of any major market, that's the biggest bubble of all time. At the time, we were told it had gone to 65 times earnings. There's always historical revisionism in the data, so you have to be a little careful. But at the time, it was clear, everybody agreed, 65 times earnings, which is pretty remarkable. And it had never sold at over 25 times before. So that's the thing that makes every value manager wake up sweating in the middle of the night is Japanese stocks. Anyway, they managed to do both of these at the same time. And 31 years later, the land is not back, real estate's not back, and stocks are not back to where they were. This was a loss of perceived wealth so profound that you have to congratulate the Japanese for not going into a depression. And people talk about a lost decade, but hell, that was a lost decade where they actually inched forward. They actually did not go even backwards for the decade. When you're taking that kind of loss of wealth, you're in trouble. Now, in the so-called great financial crash, which irritates me as a title because I think it was a housing bust, the housing market had this perfect 3 sigma, 1 in 100-year outlier bubble. It had been very, very stable historically. So to get to that level, it only had to go up only, he says, about 40% or so in 2 to 3 years, which it did. And then it gave it all back. But the trouble with 2007 housing bubble is it took the stock market with it. The stock market was not sensationally overpriced, but it was a big overpriced bull market. It was not in itself a bubble. The housing market was a bubble, a beautiful, magnificent bubble. And if you look at it, it's perfectly round. It goes up for 3 years. It goes down for 3 years, exactly the same speed. And it goes all the way back where it came from. And the housing bubble inflicted about $10 trillion of loss of perceived value. So 1 minute you thought your house was worth 400,000. 3 years later, you were told it was worth 550,000. 3 years later, you were told it was 400,000. And 2 years after that, 350,000. To hell with that. So you had lost an enormous asset. And housing markets are much more dangerous because more people own them. The middle class in particular that owns very little stock owns a lot of housing. And it really, when you lose that value, you skip the trip to Portugal and you realize you can't send your second son to private school. And it really flows through the system. And don't do it. So what do we have this time? We have, of the 4 major asset classes on the planet, we have 3.5 in bubble land. We have, Jim Grant would say, the most overpriced bond market and the lowest rates in the history of man that go back 4,000 years. There was never a time when so much had a negative return where you pay the government to take your money. So that's number one. Number two, we're a contender for the highest priced US equity market in history. I would say a majority of bubble experts think this is now slightly higher than 2000, which was epic. And some people do not, but at least we can all agree it's a contender. And then we have real estate. And real estate was kind of off screen until a few minutes ago. And suddenly, on some of the databases, it has risen 20% in the last 12 months. Schiller's series, a little more conservative, lags quite a bit. I think it's only up 13, but the other series, perfectly seriously done, up 20 is the sharpest rise, sharper than the 70s with inflation and sharper than the housing bubble of 2005. And what that means is the metric we hero worship is multiple of family income. How much does the median house, the one in the middle, how many multiples of the median family income is? It's a nice, stable, fair metric. It used to be in America that we'd sell at 3 times family income. And in the bubble, we kind of went to 4.5 or so and then back. And we are now at the multiple of family income that we were in 2006, the very peak of the housing bubble. We're back. Now, the rates are very low. So all being well, you can, quote, afford it. What you can't afford to do, if you're a beginner, is buy it in the first place, which brings up another topic we should address sooner or later, and that is how painful for most people high asset prices are. They're kind of fun when you own them, and they're great for retirees who have nothing to do but liquidate their pile of assets. But for people who don't have it, and for society in general, it's a disaster, because what has happened over the last 25 years is that the yield on assets has dropped as the price rose. And I study forestry and farmland, and that around the world used to have, let's say, a 6% yield, and now it has a 3%. And at 6%, you can reinvest and double your money in 12 years. And at 3, it takes 24 years. So in 48 years, you have a quarter of the wealth, ignoring taxes for a second, a quarter of the wealth that you would have had in the world on average of the 20th century. This is terrible. And the same with a house. You're getting half the house that you used to get for your income. It's a disaster for people who don't have assets. And the whole society is compounding its wealth much more slowly. It's such a simple arithmetic point, but nobody seems to get it. It is slowing our wealth creation down and giving us the illusion that we're all getting rich. And of course, if you have a house, you know that the house hasn't changed. House was the same house at 300,000 as it was at 450 and back to 300,000. It's the same darned house. It doesn't hold off the rain any better in a housing bubble like today. And it's the same with stocks, by the way. They're the same old stocks. Only in stocks, you get the fantasy of pretending that somehow their earnings have gone stratospheric. And you can expand the storytelling to fit the available price. And that's why bubbles in the stock market are so dangerous. But when you look back, you find there was no dramatic shift in long-term earning power in 2000. It was just a game we all played. There wasn't even in Japan. There was a fairly modest upswing in profit margins. And profit margins are, as I like to say, the most provably mean reverting series in economics. So if you pay up for rising profit margins, that is absolutely the wrong thing to do. You should pay up for crushed profit margins because they always bounce. You should pay down for heroic profit margins because they always move downwards. Anyway, so here we are. We have the trifecta. First time in American history, the real estate market, the bond market, and the stock market. And then coming up on the rails, as they say in horse racing, are commodities. If you take the Goldman Sachs index for non-energy, they have a ludicrous total index. It's so dominated by oil that when they break out oil and non-oil and the total index, you can't tell the difference really between the total index and the energy part. But if you look at the non-energy part, which is all the metals, all the critically important foods, and plus one or two other things like cotton, it's back to the all-time high of 2011. It's back to that epic move in commodities. I mean, who knew that? Only a nerd like me who looks at the data. But the broad base of commodities, that a lot of them that count, are back to the all-time high. And the UN Global Index of Food Prices is not far off its 2011 high. And then there's the more complicated story of energy, because energy in terms of fossil fuels is in the end game. And that is incredibly complicated and difficult to predict. But you know for sure that in the end, little fossil fuels will be used in 50 years. But who knows what the flight path of price will be. All we know is that the industry is liquidating. And when you look back, by the way, you have an amazing testimonial to the stock market, because you haven't been able to read in the headlines that the oil industry was going to implode in the last 20 years. But in 1982, at the top of an oil crisis surge, the oil industry was 23% of the S&P 500. 10 years ago, it was 13 or 14. And today it's about 3. So somehow, in its own dopey, slow, meandering way, the market has marked down the oil industry more, get this, than any other major sector of the S&P since the S&P started in 1925.
Wow. What does an investor do if we have 3.5 bubbles? Is it have more ex-US assets? Does it have a value tilt and then just a little bit of cash and ride out the storm? What do you do if you need to be pretty much fully invested?
Well, the interesting irony here is that real estate is everywhere. Vancouver is more expensive than where I am today in San Francisco, by a lot. As a multiple of family income, it's so high it doesn't seem to compute. The same is true across Canada, Toronto. It's in Sydney, Australia, New Zealand. It's in Paris, London, Hong Kong. The overpriced real estate is pretty well global. The lower return on farms and forests and what you might call other assets is pretty well global. The lower return on bonds, absolutely global. The paradox, or the slight irony here, I suppose, is better, is in the stock market, where it really is focus most on the US. And although the developed countries are, quote, overpriced, it's fairly business as usual. And there are some countries, the UK, for example, and some would argue Japan, are not particularly expensive. And emerging markets seem to be perfectly ordinary, which means against the bubble US, they're one of the 2 or 3 lowest relative points in history. And from those other points, they have done very, very well indeed. As recently as 2008, emerging markets sold at a PE premium to the S&P, and now it sells at half. And that's a pretty decent discount. And the other thing, of course, is value. The higher yielding value stocks are more sensitive to the discount rate shift. So as the interest rates go down, they tend to underperform and growth stocks outperform. And if we're looking at a period where interest rates slowly wend their way back, at least in the direction of the entire 20th century, what happens is the reverse.
One thing that in my life that I've noticed is that for most of my existence, I could buy a gallon of gas cheaper than I could buy a gallon of milk. So did we systematically underprice carbon given its risk?
If we had somehow worked out, as we can today, what the societal cost of a ton of carbon is, and priced it back into oil, as we should have done, of course, in a perfect world, we would have had a stunning tax on all fossil fuels like the Europeans have on gasoline. And we would have had it as they did on gasoline 40 years ago. And we'd be living in a different world because it would have summoned up all of the ingenuity that we're capable of. And we would have found a way to invent efficient electric cars and so on 20 years ahead of today. And all of the interesting inventions have been underfunded and certainly on the part of the government, enormously under-researched. And these are the areas that government research has done so well from time to time. Of course, a classic example would be developing a nuclear bomb in 3.5 years instead of 35 years, but nuclear power and internet and early days of solar. And even Tesla got a big government grant. And yes, of course, you have lots of failures, but these are the industries that change the world. And incidentally, this is the one area that the US is still absolutely exceptional. Americans love to think of themselves as exceptional in everything. And this has sadly not been very accurate for the last 40, 50 years. We seem to be sliding down almost every list that counts. Math effectiveness of students and number of people in prison and murders, and you name it, we have not been doing too well. But in venture capital, in new industries, we have been the top dog for the entire 55 years I've been in America. If you look at the FANGs, the FANGs are what separate us from the rest of the world. The earnings progress and the market progress of the ex-FANGs US is not that different from the rest of the developed world. But the earnings of the FANGs have been exceptional, and the price, therefore, has also been exceptional. You look at them, they're all venture capital firms. They're not outcroppings of the old Coca-Colas and IBMs. These are firms that I consider pretty new. When we were starting GMO, we hired away what would have been employee number 26 at Microsoft. And Apple was about the same age. And I just don't consider that very long ago. And of course, the rest of the FANGs are 15, 20, 25 years from the day they started in the garage, as it were. So this has been remarkable. And it is a great strength, and we should play to it. And the government should really encourage basic research. We are in the process, sadly, in the last 10 years or so, of ceding all the new industries of the future to the Chinese. They make over 80% of the solar panels. They produce over 50% of the electric cars. They make 400,000 electric buses, and we make 1,000. I mean, get a life. They're shipping them in the hundreds and hundreds to the cities of South America and so on, here, there, and everywhere, and driving the cost curve down. They have more fast trains than the rest of the world added together. And so it goes on. And they put in more wind last year than they put in 75% as much wind last year as we have ever put in cumulatively. So we can sit back and be anti-Chinese, or we can say, to hell with that. We don't want them to dominate these industries of the future, the greening of the global economy. And we have to get behind it with our government as they do. And we have to encourage capitalism and venture capitalism to do their best. And they're well positioned to do it. They just need more money. You can afford failures. If you look back at 2000, how these great surges work is you wipe out 19 of each 20 new companies, but somewhere in there is the Amazon. And if you do it at that scale, as we did then, we're the guys in the US who end up with the Amazons and the new technologies, not the more conservative Germans, shall we say, who are very good at manufacturing. But when there's a new breakout, it plays to our strength, and we should get behind it.
Creative destruction. One of the great economists of the world talks about creative destruction. From the ashes, these things come up, and it's important to invest. And we're going to talk here in a second about your foundation and all the great work that it's doing. But you're talking about predicting bubbles and the tops of markets. You've made some dire predictions around climate and climate change. And I believe you've said, hey, look, we've got about a 50-50 shot here of it not having a major impact in our daily lives. In a concise way, why don't you share your feelings about the risks that we have right now?
Well, I was asked that question about 5 or 6 years ago, and I said 50-50. And since then, I thought the odds moved against us, drifted down. We were not winning. Let me just point out that the particles of CO2 that went up into the atmosphere were more last year than ever before. So we haven't even started to win at the second derivative.
Even with COVID and the slowdown, we still pumped in more carbon than ever before.
More particles than ever before. Now, we have got to get our CO2 production down to zero. We have actually got to get into the business of sucking it out of the air one way or the other, biologically, chemically, physically. And to get there, of course, we have to first see the rate of growth go negative, and it has not. It's not just that it's growing at an accelerating rate still. And that applies to the melting of the ice in particular, the ocean level warming in particular. It is warming in the last 15 years at 3 times the rate it was 40 years earlier. This is just a terrifying rate of increase. And the water levels are rising at an accelerating rate. And every time there's a serious, even conservative estimate, it edges up over the one of 5 or 10 years earlier. So this is at the moment something we're not winning. Now, there was a recent meeting of the G7, which everyone has to process, where they came out with a really surprising, dramatic agreement that they would downgrade fossil fuels across the board and pretty well kill coal. And if they can cajole, bribe the G, whatever it is, 21 or 23, what is it? But 20 odd, which includes China critically, then we're really moving, because China and Japan were the ones who were funding coal. And China is in the G7 and shocked everybody by agreeing to stop it. And now we want to persuade, cajole, shame, whatever, China into doing the same. And maybe they'll volunteer for propaganda reasons, or for PR reasons would be more polite. So that is a terrific late developing piece of news. And that may take us back to the 50-50. We frame this as the race of our lives, because we have our nose rubbed in at one end to the spectacular technologies that are going on in the VC world that can change the world. And on the other hand, we have our nose rubbed in to the data, which is been deteriorating at an accelerating rate. So we know more of the bad news than the technologists and more of the good news than the environmentalists, which is an interesting place to be. It really is a race, and we can win. And on paper, if we lived up to our capabilities, we would win.
One thing I appreciate is that you have put your money where your mouth is. You've put in not more than a majority, but almost the entirety of your wealth into your Grantham Foundation for the protection of the environment. So talk a little bit about the mission of that foundation.
The mission of the foundation is to be like the shock troops, to find those areas that are the most important and the most difficult to fund, whether they're investments or grants, that they're politically incorrect, they are badly understood, they're too new, they're too risky, and yet they're potentially critical. So we look to find the cutting edge of the grant-making world, the people with the most fire in their bellies, with beautifully designed programs that will count and can be leveraged and will set a good example. And then in the investment side, we're willing to deploy up to half of our total foundation in early stage green VC, for heaven's sake. And maybe one day we will go beyond that. but that is still far out of our reach. We're probably up towards 10 or 12, 13%.
I think that's interesting, right? Because a lot of foundations will have an asset allocation that supports their mission, right? You're doing that, but you're also having your assets support your mission.
Yes, and too few people who are well-intentioned in the foundation business use their assets to drive the mission. They talk a good game, but when you get down to it, they're not really in that business. They're not taking any extra risk. And this is, let me point out, this is the only case of having your cake and eat it that I have ever come across in my life. And it goes like this. When we invest in a dynamic early stage VC with an idea that if it worked could change the world, I think on average, a portfolio of those ideas is driving the cause towards decarbonization successfully. It's driving it as well as any dollar we could make in a grant. It's just the most effective dollars that we can spend are on these new brilliant ideas. And secondly, now that the governments are getting behind us, now that people are really appreciating the dangers we're in and what a race it is, I think they are candidates to be the best money-making portfolio that we could make. Now, how often in life does that happen? You know, if you love chocolates, it makes you fat. We have this exciting job description. My God, these investments are exciting. They are absolutely vital. They're exactly what we should be doing. And they might make us more money than any other foundation, which would be really cool because that in turn drives up the grants we make.
For larger institutions, they can do early stage venture. If you're a smaller foundation, can you still do this? It seems like you want to be more on the private side than the public side. There's talking about bubbles, that there are certainly some very overpriced EVs out there and battery technology and everything else. Should you just, if you're smaller and can't do the venture side, should you kind of just stick to your knitting?
You can be fairly small and still invest in a professional green pool of venture capital. They're coming out of the woodwork, some of them from firms with great records in more diversified VC. Some of them are brand new startups. We know some of the players, so we are happily investing in these guys. And I think on average, they'll work out well. Do prices get ahead of themselves these days? In some cases, yes, they do. You know, the SPACs are coming out with lots of green looking things. And the SPACs are I think, a ludicrously speculative instrument in general, and they badly need to be controlled, which happily the new administration seems to agree with. But I mean, the good news looking back is they will have raised a lot more money probably than without them. Yes, they end up ripping off the ordinary investor and giving huge rewards to the people with the willingness to propose them and run them, who take 20%. They don't take 20% of the winnings like they do in venture capital. They take 20% of your money.
But you've had some luck with SPACs, right? You had a big private go public. QuantumScape, is that correct? QuantumScape.
One has to say a brilliant enterprise, which has covered an enormous amount of ground, but is still a number of years away from having revenues and profits, maybe 3 or 4 years, and still making very nice progress and has very plausible people like VW and Bill Gates backing it. But you might well argue that this should be better served by a group of venture capitalists sitting around the table than having it enter a bubbly environment. So this thing came at 10, which was okay. That's what we were carrying it at about. That's 4 times what we paid 7 years ago. And then it went to 132. And suddenly the few percentage points that were in my name had ballooned to an amazing level. And it was $625 million worth. It was the biggest investment we had ever made. And on Monday, we came off our 6-month lockup, and the stock, sadly, was down to 25. And you can say, well, 25 is lovely. It's 10 times our investment. Or you can say, that 132, I could taste it. And we could use all the money. And on Monday morning, 75% of our QuantumScape was transferred to the public trust and the family foundation, which takes my rather larger share of the total back down where it belongs. But we will see how this plays out. We're going to hold quite a bit for the 4 years to see if we pull off this rabbit. I mean, it's half the weight of a traditional battery, half the volume. So you can get 2 days in your telephone instead of a day. You can, have 500 or 600 miles of range in your car, or you can have a lighter battery. If you have the battery size, it saves 500 pounds of weight in a Tesla, say, and then you save the cooling equipment because the new technology doesn't overheat and blow up. So that's probably 800 pounds of weight that a Tesla equivalent machine would save with this battery. And it charges in 10 minutes plus or minus a couple, which is, so you get a cup of coffee. And the mayor of the city says that every gas station has to install an equivalent number of electric charging. And it's no skin off their nose, because if you find a way of financing the pumps, that is, the charging stations, because they make all their money at the little shop selling coffee and newspapers and this and that. And these guys will still be taking 10 minutes, which instead of 5 minutes. So they would like that.
That sounds like a great investment, and congrats on having such a big win. We're kind of getting later into the podcast. Maybe just highlight one technology that you're invested in that you're really excited about, if you can.
I have to back and fill for just a second here, because one of the things we still own in the foundation, we own some publicly tradable securities. And I'm happy to say that GMO has been now running a climate change fund for 3 or 4 years and has a very nice track record, and looks at the question, how is the world going to change with decarbonizing the economy? How do we get ahead? How do we understand it better? And how do we make money from the greening process? And we do that in the tradable market. So it's more accessible than building a portfolio of VC. The most exciting, there are many exciting VCs, but I'm going to tell you about one called Greenlight in Boston. They had a breakthrough in the producing RNA, and we've all suddenly become familiar with RNA because of Moderna and Pfizer, both of whom are brilliantly successful vaccines and based on RNA. And a lot of people, as recently as 3-4 years ago, didn't trust RNA as far as they could spit. They thought it was an expensive dead end, and it absolutely has proven not to be, of course. But RNA is very, very expensive to do research with. It was $100,000 a gram, and then it was $10,000 a gram, then it was $1,000 a gram. And now it's less than $1, and the cheapest of all processes is owned by Greenlight in Boston. And what they found before the COVID was the potential to turn this into insect control, where you instruct the insect to behave differently. You modify its DNA by having this messenger RNA instruct it. And so you tell the Colorado beetle that it can no longer process carbohydrates. So it eats the potato and dies of, I'm not sure whether it dies of starvation or constipation, but in any case, it dies. And it's very, very much less intrusive into nature. It doesn't affect even a cousin beetle, and it's much cheaper. So this could be applied, one imagines, to farming length and breadth. And we are very worried separately about the toxicity of the environment. It's killing off all the insects. The insect mass is down at least 50% and probably 70% in the last 100 years. And no one knows what the consequences will be of this cascade as you lose your insects, your birds that eat the insects, your amphibians that eat the insects, and so on. And it rolls through nature with, as we often find, unknowable, unintended consequences. And it could be, E.O. Wilson, the famous Ant-Man, says, we can really do easily without humans, but we can't do without insects. The whole ecosystem collapses. And anyway, so that's one of the spectacular ones. And there are plenty, lightweight vehicles that could be made for a couple of $1,000s and so on.
That's really exciting. And we really appreciate you kind of sharing some of those ideas, the new technologies, and also just sharing how not only a big institution can invest, but also even smaller institutions, that there are funds, there are ways to get some of that mission related investing so you can have your cake and eat it too. So you're calling markets, you're saving the world. What are you doing on your free time? Any hobbies?
I like to play tennis. I've had tennis elbow for about 40 years, so it makes for an interesting game. So I have to do a wicked backhand underhand serve. which creeps over the net and hopefully doesn't bounce too high. But that's a hobby. We cycle. We've been spending the last year down in the countryside, so that's handy. But my real hobby, I suppose, these days is the foundation work, which who would have guessed it would be so entertaining? And the grant making is interesting enough. It's really, you meet very good people and it's quite a challenge. But the investing has been just a bonanza. So we have built up a team. We have 6 people who do direct VC investing ourselves. So yes, we invest in professional pools, but in addition, we do it ourselves. And we have built that up to about 50 million, a few percent of our total, and it's growing rather rapidly. But it's absolutely exciting, and it keeps us very well plugged into what is going on.
Tennis is great, cycling is great, but saving the planet and focusing on environmental concerns is an absolute great hobby to have.
Let me just say that, they say, have you any advice for the younger people? And of course, it's obvious from what I've said. Get into venture capital, ideally green venture capital. Start a new firm. If you can't do those, then at least do what you can to help the world in its race to greening everything. Work or help an NGO, give to the best NGOs, influence your company. That counts for a lot more than people would imagine. Just the workers pushing for better, greener behavior really helps. And my advice to everybody is just remember that time passes a lot quicker than you expect. And you too will be sitting on the bed chatting when you're 82 next Wednesday. Trust me, it's quick. And the message is don't hang around, don't compromise any more than you have to. Take a little more risk. I wonder how many people actually sit on their deathbed and look back and say they took too much risk. Yeah, a few. But for every one of those, there's 10 or 20 of us that took too less risk. I would certainly take more if I could do it again. Move quicker, take fewer prisoners, just try and make a difference.
For those younger folks, give us one book recommendation on the environment and then maybe your favorite book on investing.
My favorite book on investing is Chapter 12 of The General Theory by Keynes. It's beautifully polished, unlike the rest of the book. It is completely unrelated to the rest of the book. So you don't have to be even slightly interested in all the contortions of interest rates and money that economists waste their time on. Chapter 12 is about real life, common sense, brilliance even, and how the market works. And you have to read it. And you can probably get it online without much trouble. And the one I'm reading now about the woman who got, the American woman who not this year, but last year got the Nobel Prize for chemistry.
Codebreaker. That's going to be our at FEG in the research team. That's going to be our summer book club. Codebreaker.
And I'm on chapter 3, and it's fascinating. It's always remarkable when a woman makes it through the scientific world because, do they have to deal with a lot of put down from the men. It hasn't been a fair fight, even more admirable than one might imagine.
Well, this has been great. Thanks for educating us on so much and so many aspects of the market, the environment, sharing all your great work with the foundation, and happy early birthday, Jeremy. Thank you, Jeremy.
Well, it was a pleasure.